if you're at the stage in your business where you need a bit of a cash injection to fuel your growth, there's basically 4 doors you can go and knock on. In this video, we're going to explain what they are. I'm Jamie Cunningham with SalesUp Business Coaching. Let's check it out. Before we dive in to the 4 doors, there's a quick distinction we need to make. When you're looking for cash for your business, there's 2 types of cash injection that you can receive. One is debt, which is when you borrow money from someone, and one is equity. And equity is when you're actually selling a part of your business and you don't necessarily have to repay that money back, but now someone owns a part of your business. So whenever you're going out looking for money, you're deciding on whether you're offering debt or you're looking for debt or you're offering equity in your business. And depending on which one of the 4 doors we're talking about is going to depend on the acceptability to that door as to whether they're going to want one or the other, or maybe a bit of both. But something to keep in mind. The benefit of equity is that you obviously don't have a drain on your cash flow to pay it back. The benefit of debt is that you still own all of your company, but you have to be able to service that debt. All right, let's take a look at the 4 doors. Door number 1 in the finance circles is what's commonly known as the 3 Fs, and they are friends, family, and fools. Now what that means is that you're generally dealing in this category of people who are a little less sophisticated, but it can have a couple of advantages and disadvantages. The advantages are that you're dealing with people who you have personal relationships with, and if they're good personal relationships, there's probably a high degree of trust, and they probably want to say yes to you. The downside of this category is probably obvious. You're starting to mix business and personal relationships, particularly around finance and lending money. It can easily go sour if things don't turn out the way that you've promised. So a couple of things to be very aware of is to make sure you put everything in writing, be clear on the risks up front as you know them, be full disclosure with the people that you're dealing with, and make sure you get it in writing. The other limitation with this category is usually that there's a limited resource of funds. Unless you know people who've got a lot of money, generally speaking, people have only got so much personally. So depending on how much you're looking for, this may or may not be at the right avenue. In saying that, there's no reason if you need more than what the 3 Fs can give you, there's no reason you can't go to the 3 Fs first and then go to some of the other doors that we'll look at next. Let's take a look at number 2. Door number 2. Door number 2 is the banks. Now banks, you're familiar with banks and what they are. You've probably had dealings with them already. No doubt you got a business bank account, personal bank account, probably got a mortgage. Well, when it comes to going to the banks, there's again pros and cons. The pros are the banks are reasonably predictable. They've got set rules that you have to comply with in order to meet their requirements to access their funds. But those rules can be quite tight. And if you are in the space where you're in commercial banking, they're going to be looking at your business, they're looking at your financials, they're looking at your asset base, how much debt you've got, how profitable you are, the strength and health of your cash flow. If you're underneath that, if you're looking at the retail space or more the smaller business, they're going to be looking at you personally, which is going to be your business, but also your personal assets and what kind of collateral that you might have. So they're very concerned about servicing. They want to know how you're going to be able to pay the interest and the repayments on the debt. And then they also want to know if you default, how are you going to be able to pay the loan back? So they're looking for guarantees. So banks are, generally speaking, very risk-averse lenders. They have a pretty narrow niche that they like to play in. There are some industries they don't want to touch, and different banks have different areas or different sandboxes they like to play in terms of industries. So it does pay to check out different banks. It also might pay to speak to a lending broker who will deal with more banks than you're aware of that are in the marketplace. There are the tier 1 banks, which you'll know and no doubt probably bank with. There'll be tiers below that which don't have retail locations, but they do lend. And so to get access to them, sometimes you need to go through a lending broker, which can be a great idea because generally these lending brokers will give you lots of good advice if you find a good one, and give you access to some of these banks that you wouldn't otherwise know about. So banks, they can be good. People love to bank bash, but they serve a purpose. You've just got to know where you fit. If you've got a high risk business, if you're a startup with no collateral behind you, odds are a bank isn't going to touch you, and you've got to put yourselves in their shoes and think, well, would you? And maybe you would, but banks, they're conservative, they're risk averse, but they have their place. Door number 3. So door number 3 is investors. And I'm going to lump investors into basically 2 categories. You've got angel investors and you've got venture capital investors. The difference between the two is perhaps they're best said in their intention. So angels are generally wealthy people, people who have made their money in their business already, and they look to make other investments in other businesses, A, so they can make a return, but B, they've also sometimes got an element of they want to help other entrepreneurs out because they've been where you are now. Not to say that they don't assess risk, they absolutely do, but they're a little more sympathetic to some of the things that can't easily be explained or that a bank might say no to. So where you can present a really good business case, you can show the market of something, you can show the potential is, you can show your track record in being able to execute and to make things happen. These sorts of things are going to go a long way with an angel. And angels, the amount they'll invest will vary, but they can be really good partners, and they can often offer or be open to debt or equity. So, a debt type angel is going to have a pretty high interest rate compared to a bank, but they're also going to not look as hard at your financials necessarily. And the equity side, they might also have some expertise they can bring to the table to help you out. Now on the venture capitalist side, this one is very much more business-like. These guys are in it for the return only. They have other people's money that they're investing and they're promising a return to their investors. So it's kind of a chain of investors. They're looking at your business to get a massive gain. So they want to know, okay, and they take a lot of risk, but they bet on things hoping they're going to explode, generally speaking. And look, I have never dealt with a VC myself, so I'm only telling you what I've heard from others. But generally speaking, they can be, pretty directional in the way they want to be involved in the business, meaning they're after a return. So if there are some things that you see as other priorities that might take away from that or extend the time frame, they may not be that interested in you going down that direction. So there's going to be a few handcuffs there potentially with venture capitalists, as there are with any financial partner, but they just depend on which one you choose. So investors can be a great one to tap into because you can avoid a lot of the hoops and obstacles you have to jump through with more traditional lenders like banks, but they've got the flip side of, now you also have to satisfy the needs of that investor. All right, last door number 4. So door number 4 is one of my favorites, often overlooked, and because it could be seen as perhaps one of the harder doors to knock on. And that's the door of your customers, or the door of organic funding. So to be able to organically fund your business is obviously going to depend on the level of investment you're looking for, but it can force you to think in different ways and force you to run your business pretty tight. So the way we can fund organically is by increasing profitability, by increasing cash flow, and perhaps we're changing the terms that we're extending to customers, or getting just tighter on the way we're running our existing accounts receivable processes. It can be negotiating terms with suppliers. It can be getting creative in the way that you are actually developing your business model. And there's actually a great resource which I'll share with you called the Customer Funded Business. A good read to give you a couple of great examples and different ways to think about the way to grow your business through organic cash flow. So check that one out. So there you have it, folks. The 4 doors you can knock on to get the cash needs to grow your business. I've used all 4, and there's no right or wrong which is the best one to go after. And obviously you've got that balance I mentioned at the start about debt versus equity. And as I also mentioned, there's no reason why you can't knock on a couple of doors or accept a couple of doors for the deal that you need to pull together to make it all happen. Good luck with it. I hope it all works out. If you'd like more of these videos, just subscribe to our YouTube channel just there, and you'll get notification as more of these videos become available. Go out there, make it happen.